If you're in lending, compliance, or heck, even just working in finance, Regulation Z isn't just some obscure rule. It's pretty much the rulebook for consumer credit in the US. It controls how the cost of borrowing money is shown to people, and understanding it, well, it's just not optional. So let's dive right in and break down this absolutely critical regulation.
Okay, so here's our game plan. First, we're going to decode what Regulation Z is all about at its core. Then, we'll get into the two main flavors of credit it covers. From there, we'll navigate the really complex world of mortgages, look at some key protections for credit cards and student loans, and then wrap it all up with some practical advice on how to actually stay compliant.
So let's kick things off by asking the one question that really gets to the heart of this entire regulation. It's a question every single consumer has, even if they don't know the official terms for it.
This simple question right here is the reason Regulation Z even exists. Before TILA, getting a straight answer to this could feel like a frustrating shell game of hidden fees and confusing jargon. This regulation was created to force a clear, standardized answer, giving consumers the power to make genuinely informed financial decisions.
Officially, what we're talking about is Title 12, Part 102 of the Code of Federal Regulations. It's the rule that brings the Federal Truth in Lending Act, or TILA, to life. And the agency in charge of it all is the Consumer Financial Protection Bureau, the CFPB. So here's the key takeaway. When you hear TILA, think Regulation Z. This is the playbook that turns that big federal law into day-to-day action.
This quote from the regulation itself really nails the mission. It's not about controlling prices or deciding who gets a loan. Nope. Its entire purpose is about one thing: transparency. Regulation Z is all about pulling back the curtain so that people can see clear, comparable information and truly understand what they're signing up for.
To make that transparency happen, Reg Z gives us two absolutely critical definitions. First up is the finance charge. The simplest way to think about this is as the loan's total price tag, in plain old dollars and cents. It's not just the interest, it's the sum of all the mandatory costs you have to pay just for the privilege of borrowing the money.
And the second critical concept is the APR. Now, if the finance charge is the total price tag, the APR is like the universal unit price. It takes the interest rate and most of the fees and rolls them into one single standardized percentage. This is the number that lets a consumer look at 3 different loan offers and make a true apples-to-apples comparison of what they really cost. So now that we've got those foundational ideas down, let's look at how Regulation Z actually applies them. It doesn't use a one-size-fits-all approach. Instead, it splits the world of consumer credit into 2 main categories, and each one gets its own specific rulebook. On one side, we have open-end credit, which is covered in Subpart B. Think of this as any credit line you can draw from, pay back, and then draw from again. So your credit cards and home equity lines of credit are perfect examples. On the other side is closed-end credit, which is covered in Subpart C. This is your classic installment loan. You get a lump sum for a specific purpose, and you pay it back over a set term. Think mortgages or auto loans. For open-end credit, the rules are really all about managing that ongoing relationship. That means you need detailed disclosures right when the account is opened, clear and consistent info on every single monthly statement, and a mandatory process for handling any billing disputes. And this is a big one. For HELOCs that are secured by a person's main home, there's a 3-day right of rescission. It's basically a federally mandated cooling-off period where the consumer can back out of the deal, no questions asked.
With closed-end credit, the focus kind of shifts to that big, upfront, one-time transaction. The disclosures have to be crystal clear about the loan amount, the finance charge, and the total amount of payments over the entire life of the loan. A similar right of rescission also applies to certain loans secured by a principal home, like a refinance. And advertisers, listen up. You have to be mindful of trigger terms. If you advertise a really low monthly payment, you are also required to disclose other key terms, like the APR.
All right, deep breath. We've now arrived at the heavyweight champion of Regulation Z, residential mortgages. Now, while a mortgage is technically a type of closed-end credit, its sheer complexity and financial importance mean it gets its own extra detailed, highly specific set of rules under Subpart E.
The mortgage disclosure process follows a super strict timeline, and it's all designed to eliminate any nasty surprises at the closing table. Lenders have to provide a loan estimate within 3 business days of getting an application, and then a final closing disclosure has to be in the borrower's hands at least 3 business days before the loan is finalized. This rhythm ensures borrowers get clear information upfront and have plenty of time to review the final terms.
So, that loan estimate, or LE, is the consumer's #1 shopping tool.
It's a standardized, easy-to-read form that lays out the estimated interest rate, the monthly payment, and the total closing costs. The entire thing is designed to make it dead simple for a borrower to compare offers from different lenders and really understand the long-term impact of the loan.
And then you have the closing disclosure, or CD. This is the final reckoning. It itemizes every single final charge and credit in the whole transaction. And its format is designed to mirror the loan estimate, which makes it really easy for the consumer to compare the initial estimates with the final figures. This is that moment of ultimate transparency right before the deal is sealed.
Subpart E also creates special categories for loans that are, well, a little bit riskier. You can think of high-cost mortgages as the big red alert category. These are loans with rates or fees way above the market average. They face some serious restrictions, and some features are just flat-out banned. Higher-priced mortgage loans, or HPMLs, are more of a yellow flag category. They trigger extra protections, like mandatory escrow accounts and special appraisal rules, to reduce risk for the borrower. And of course, reverse mortgages get their own specialized rules because they're just a completely different animal.
Okay, moving beyond mortgages, Regulation Z has dedicated sections for other specific credit products where consumers really need extra protection, namely credit cards and private student loans.
A really key provision in Subpart G is the ability to pay standard. This rule was a direct response to the old days of fog-and-mirror lending, where if you were breathing, you could get credit. It requires lenders to make a reasonable, good-faith check of a consumer's income and assets before they issue a card. It's a crucial safeguard against people getting buried in debt they can't handle.
And Subpart G is just jam-packed with other consumer-friendly rules. It puts strict limits on penalty fees. It heavily restricts when a company can jack up the interest rate on an existing balance. And it even sets specific rules for marketing credit cards on college campuses to protect younger and often less experienced consumers.
And private education loans? Yeah, they also get carved out for special treatment under Subpart F. See, unlike federal student loans that have standardized terms, the private market can be all over the place. Recognizing just how huge this debt is for young people, the regulation mandates a unique set of disclosures and consumer rights tailored specifically to the risks of student borrowing.
Okay, we've covered a ton of rules. So for those of you on the front lines of compliance, how do you manage all of this? Well, the good news is the regulation itself actually provides a toolkit to help you out.
First and foremost, documentation is everything. Section 1026.25 is crystal clear. You have to keep records proving your compliance for at least 2 years after disclosures were required. And for mortgage lenders, that period is even longer for certain key documents. This isn't a suggestion. It's a hard and fast rule that examiners will absolutely verify.
Now, the regulation also provides several powerful tools to help you stay on the right side of the law. The appendices contain model forms for pretty much every required disclosure. If you use these forms correctly, it gives you a legal safe harbor, meaning you're presumed to be in compliance. For all the nuanced questions, Supplement I provides the official staff interpretations. Think of it as the detailed instruction manual. And always remember, TILA sets a federal floor, not a ceiling. You have to check for any state laws that might impose even stricter requirements.
And this really highlights a key challenge, doesn't it? Regulation Z has created this incredibly detailed framework for transparency, giving consumers more information than ever before. And yet, financial literacy and just managing debt effectively are still significant hurdles for so many. The regulation can mandate disclosure, but it can't ensure comprehension. And that leaves us with a critical question to think about. How do we bridge the gap between just providing information and creating true understanding?